I see what's happened, and as far as expectations for this China deal, it's completely swung towards not happening to now 85% or so people think so. And I just get the sense this is the last kind of oh my God shot before people start to sell into the rally. And I actually think that the issues with China are not just the trade deal. I actually think the growth rate is the problem at China. And I think, to me, that's a bigger risk right now than anything else.
But you know they're stimulating the you-know-what out of the economy there. That's not going to change anytime soon. The economy here is pretty good. The economy here is pretty good, no doubt about it. But one thing I learned from being overseas, China is as big as they come. And the investments that they're making overseas are enormous. And God forbid they slow down even a little bit. Steph, broad-based rally, financials, bank bounce, finally working. Year-to-date performance on the banks. Citi up 27%, Goldman 22%, Bank 21%, Morgan 12%, J.P. Morgan 10%. Yeah, and you're adding to positions.
Yeah, I mean, I've been nibbling at Bank of America and J.P. Morgan. J.P. Morgan is actually fairly new for me. I've been selective up until this point, but I do think that there is a catch-up trade there. Overall, we're up 20% from the December lows as in terms of the market. And we have seen multiple expansion from 14 times to 16 times, but 16 times compares to 18 times this time last year. So I actually think that interest rates is what's really driving this market, not China trade and not, kind of the global growth slowdown. We know about that. But with the 10-year at 2.6, global rates around the world low and depressed, that's actually very good for stocks. And I think you're starting to see some green shoots in Europe and also in China. So I think my case that I've made before earnings troughing in the first quarter, GDP troughing in the first quarter, I still feel pretty good about that. I think we're going to see improvement as we go through the year.
Doc, new highs? Is that where we're going?
Yeah.
The trend, your friend, as Jim Lebenthal said, Farmer Jim?
It is. And just as Ian and Jim said about when they were speaking about China, that is something that could derail things. I'm not looking for that. I think overall we have a China put because of what you mentioned when Ian threw out the China issue, which I don't disagree. And I'm just saying that I think that overall that amount of stimulus, another 125 billion in stimulus over there, tax cuts over there, I think that's the equivalent of a put over in China. So that's why I don't think that rears its ugly head and becomes the bad thing. But to Jim's point, if those talks really broke down and all of a sudden they both got punitive and went after each other, Xi Jinping and our president.
We haven't even had any headlines or anything on China lately. Maybe that's been the best thing for the rally in and of itself. Whether it's positive or negative, a headline, the market just doesn't have to deal with it.
Well, and you'll get some from FedEx and Nike this week.
And Micron, by the way, too. Good points. But, also synthesizing what Doc and Steph are saying here, one thing that's left out, because you mentioned green shoots in Europe, Steph. Yeah. Europe is getting back on its feet, and we could have a self-inflicted wound. A third risk here is if we put tariffs on European autos. That would put a stake in the heart of Germany's economy right when it's getting back on its feet. Germany is the engine of growth for Europe. Now, Europe is never where you're looking for, a powerful move forward in GDP, but they were at 1%. If we get them back towards 2%, that might ameliorate your very good point, Ian, that China is important and is not growing as fast as we would like. I recognize Europe is not China. Nonetheless, what I'm saying is we could have a self-inflicted wound if we start to really ramp up the rhetoric and the tariffs with Europe.
I mean, stocks are at the highs of the day. Okay, Dow certainly is. We just showed you the intraday chart there. You can't ignore the trend. Right, where the momentum now seems to be.
There's no question.
And if you have financials working now and technology's been working now, the FANGs have woken up.
I mean,
harder to make a more negative case, isn't it?
Financials specifically with the yields here, I find it hard to see them going too much further from here. But as far as the overall market, I mean, look at the amount of money that came out of funds in December. To me, this is just all that money coming back in and going to be another. Remember what happened the last time we came out of Argentina with China and everybody was all excited? Straight down. So I wouldn't be surprised if you saw a similar type reaction this time because everybody's expecting it.
Yeah, but there were 70 billion of outflows in U.S. equities from October to December. That didn't all come back in the first couple of months of this year. I think that is going to continue. That momentum, it takes a while to get that money into the system. And I think this rally has been so hated and it's been such skepticism out there. And I think the data points in terms of the macro, in terms of the economy, are actually pretty good. I mean, and then as I said, I mean, if you look at Europe, I mean, they're certainly benefiting from the euro being low. Exports are actually better. Industrial production was actually better. Retail sales is actually a little bit better. These are good things that nobody really is talking about.